banks have known there's been an issue here really starting in 2023 when interest rates started really going through the roof. Cap rates expanded, which means the value of these properties is going down while the debt on the interest expense is going up. Not only are cap rates going up, but also your NOI is going down. Literally nothing is going in the right direction for these guys.
You want to make sure you're spreading the money around and that you're also stress testing your portfolio. Like, what if? What if interest rates go up a lot? What part of my portfolio is going to get hurt the most? And anytime you invest in something and you're hoping the government's going to change rates in a dramatic way, that's probably not a good place to be. Just because there's tax benefits, if you lose all your money, you won't care about your tax benefits. And no one was thinking about defense.
Yeah.
And sometimes when you have a market that goes on that long, you should think a little bit about defense or what might not go well.
Jim, welcome back. Episode 2.
Yeah.
You excited? We made it.
We're real podcasters.
We're real podcasts. I wonder what the stats are of how many podcasts make it to episode 2.
I don't know. It's got to be 1 in 10, maybe, I'm guessing.
1 in 10. Okay. Well, we're in the top 10% just for sticking around. I think that's how you've made it so far in your career. And actually, I was taught this as a kid too. Just show up.
It's my story of my life.
Show up day in and day out. It's like you don't lose until you quit. So if you just show up over and over again, life is a game of attendance.
When I dated Mimi, I just kept showing up.
Yep.
She's like,
you wore her down.
This guy has got to get tired. Nope.
You wore her down to a yes.
I did. It took me 3 years.
What a winner.
Down to an X, a yes, and here we are 30 years ago.
Yep.
30 years later.
And now you just, I like it. Well, hey, you made it. Congrats.
I made it. That's my biggest accomplishment in life.
Well, I'm excited. We got a good docket here. We're going to continue to talk through OB3. So, a lot of these things we're going to be talking about today are going to be some changes that are happening more on the personal side from the new One Big Beautiful tax bill. And then we're going to jump into behind closed doors. We're going to talk about ESOPs, a little ESOP revolution going on. We're seeing a lot of traction with ESOPs with our small business clients.
Yeah.
We've done an ESOP ourselves, so
we have
seen that. And also, big space that's growing in ESOPs is cannabis companies. So I'm going to break that down. I'm going to educate you on why cannabis companies are doing a bunch of ESOPs.
Yeah, when I was a kid, I never thought that would be legal anywhere in the United States.
You were just drinking your Bud Heavies as a 12-year-old in Tucson.
Yeah. No, I was a kid that didn't do any of that stuff. But if you would have told me marijuana was going to be legal at any time in the history of the United States, I would have said that's impossible.
Yeah, the world is changing.
You know.
All right. Well, then on market intelligence, we're going to go into the multifamily crisis, or is it really a crisis? We're going to go through all that. I love having that conversation because we're seeing some issues definitely with some multifamily stuff there. So let's go ahead and get started with OB3. And the first place that I want to start is really talking through the individual tax transformations here and starting with qualified opportunity zones. And so maybe let's start by laying the groundwork of qualified opportunity zones and maybe tell us what they are, how they were created, and then we can go into how they've been pivoted a little bit and changed.
Yeah, well, it came out in the tax law of 2017 to try to encourage people to invest in underdeveloped, underprivileged areas of the country. And so those are designated qualified opportunity zones. If you were in the old program and you owe your taxes in 2026, you didn't get any break. You still have to pay your capital gains in 2026. So the way the new law works is if you have a capital gain and you roll it into a QOZ, you don't have to pay the capital gains tax right away. You get to defer that for 5 years and use that money any way you want. So if you had $1 million gain, you were going to owe $200,000. You could invest that $200,000 for 5 years before you have to pay it. At the end of 5 years, you get a 10% step up in basis unless it's a rural QOZ. Mm-hmm. Then you get a 30% step up in basis. So with those same numbers, at the end of that 5 years, a 10% step up in basis would mean of that $1 million, you don't pay tax on $100,000. So that saves you $20,000 if you're in a 20% bracket. If it's a rural QOZ after 5 years, you get a 30% step up. That means of that $1 million, you wouldn't pay taxes on $300,000. 20% of $300,000 is $60,000. Then if you hold for another 5 for a total of 10 years, then you can sell that investment and pay no capital gains on the gain. So if you invested $1 million, that grew to $2 million. That extra $1 million you pay no taxes on. So that's kind of the basic bare bones of the way the QOZ works.
The end goal for Congress was capital gains. So you sell an appreciated stock, an appreciated business, an appreciated piece of real estate. It's the gains that you can roll into these low income areas. You can defer the tax liability, get a partial step up in basis, And then when you hold it long enough for 10 years, you don't have to pay any taxes on the growth of that new investment. Now, there are some things where you have to do some improvements in there. You got to double the basis and make some investments. They don't want you just, buying a rental property. They want you to improve it, or they want you to, go from dirt to ground up. But I think you did a great job summarizing that. Where I've seen QOZs be the best is really when I think about it, it's going to be real estate operators and developers, because they can go buy some dirt, they can go ground up, and they can roll over these gains, and then they can pay no taxes if they hold that property for 10 years. And so in my experience, it's really these developers, these real estate professionals. Then let's talk through that a little bit, because I think that it's not just the deferral of the gain, which is okay, that's nice, you kick the can down the road. But if you then buy a property or you buy dirt, you can then take out some leverage, and then you can do depreciation. You can stack some of these strategies we talked about last year and then pay no taxes out on the back end. How would an entrepreneur go about doing that?
Wow, that's really good. And yeah, it's very true. So, I mean, just like any other real estate development project, they could develop it in the same way. They can take debt from a bank. They can do a cost segregation study, as we talked about on the last podcast, to accelerate depreciation. So they can not only get the QOZ benefits, but they can get the normal real estate benefits that you get, 100% bonus depreciation, all those types of things in the current OB3. The other thing that's really cool that excites me about the way this works is after you sell, let's say you hold more than 10 years, normally, if you sell a real estate property and you don't 1031 it, there's this thing called depreciation recapture. It's that thing that bites you in the rear end that you don't expect. In this, there's no depreciation recapture when you sell.
And I think let's go through an example here. There's going to be a lot of numbers, but I think this will help quantify the impact here. So let's assume that you're a real estate developer. You have a $10 million deferred gain that you want to roll into a rural qualified opportunity zone. So you borrow $15 million, you invest $10 million of rolled gain. So that's a $25 million total capitalization. All right, and you're going to just go vertical, right? You're going to go ground up here. Well, normally, once you put that building into use, you'd write it off over 39 years if it's a commercial property. But with a cost segregation study, you can accelerate a lot of that into the first year. So maybe you've got about $3 million worth of that, or $6 million, probably in somewhere in that range, that you're going to be able to 100% bonus depreciate. So while you've deferred the taxes on that $10 million, once you place, kind of your vertical in year two, whenever you place this into service, you're probably getting a $3 to $6 million tax deduction again up front. Let this building grow, fill it up with rent or whatever you're doing there. You're going to take some ongoing depreciation, but then in year 5, you're going to have to recognize the taxation. So again, we had that $10 million, but since we're in a rural QOZ, we get a 30% step up in basis. So instead of paying taxes on 10, we're going to pay taxes on 7. So that's going to save you, it's going to be a tax due of $1.67 million or so. That's going to, it's going to save you about $600,000 of taxes. Now you want to hold this thing for 10 full years, because then if that property that, again, was $25 million total investment grows to, let's say, $35 million, that whole $10 million of appreciation, no taxes. And normally when you sell that property, like you mentioned, we got to recapture all that depreciation, that $36 million we wrote off. Nope, not here. So that's how you can stack this strategy. And I think it's really, really powerful for those qualified opportunity zones, for those real estate developers, and really real estate is where I see the QOZ benefit being the biggest.
I agree. And one pitfall that I see sometimes from entrepreneurs is they hear the tax benefits, they don't know anything about real estate or development, and they throw money in a QOZ investment that gets pitched to them. And like we say with any type of investment, don't let the tax tail wag the dog. Just because there's tax benefits, if you lose all your money, you won't care about your tax benefits.
So true. All right, the next thing I want to talk through, I wanted to talk through is Trump accounts, but honestly, Trump accounts are pretty boring. Do you want to talk about Trump accounts?
Not really. They are pretty boring.
Okay.
And I don't see a lot of opportunity where you would use those.
Yeah, me neither. If you do have a kid, I would sign up for it. It's a child born after in 2026. You get $1,000 from the government, so that's nice. But yeah, I agree. With the 529's been enhanced with the One Big Beautiful Bill and the different account structures you can get set up. I totally agree. Those it was interesting how the Trump accounts originally sounded amazing in some of the House and Senate proposals, but the actual final bill, I just don't really see a whole lot of use cases.
Yeah,
there.
Do we need another retirement type plan? I mean, we have so many plans out there, and that was one of the things I didn't like about OB3 is they created all these deductions, and part of it was campaign promises, no tax on tips and no tax on Social Security, and the way that filtered through this new tax law was creating these one-off deduction things that are going to make the tax return way more complicated and harder for people to understand. So that I thought was I didn't really like that about the OB3.
Yeah, me neither. Okay, well, let's talk through 163J. Really, this was from the Tax Cuts and Jobs Act. This limited how much interest expense you could write off on your tax return. So we didn't see it a whole lot, but we saw it for different operators and entrepreneurs who were doing roll-ups. So if they were using a lot of debt to go buy other companies and tucking them in, or we saw this also in partial ESOPs, if they had a lot of leverage, a lot of debt, and they weren't a full ESOP. And really the rule was saying that, hey, if you had over 30% of your EBIT, so earnings before interest and taxes, was on interest expense, that was the cap on how much you could write off in terms of the deductibility of interest expense on your tax returns. Now, with the new changes, it's based off of EBITDA, so 30% of EBITDA. So really, it's kind of a bigger number times 30%, which just means you can write off more interest. And then also $31 million small business threshold. So unless you're doing over $31 million of revenue, this doesn't even apply to you. Any thoughts or reactions on the expansion of the 163J?
I think it's actually going to be really good for anyone who has a lot of depreciation and amortization on their books. It's going to make a big difference for them.
Yeah. All right. Well, let's talk through Schedule A. I think this was one of the biggest changes on the personal side. And Schedule A is where all of the itemized deductions are taken. So as a taxpayer, we get to take the larger of the standard deduction, which is $15,750 now per person. Double that. It's $31,500 if married. Or the summation of all of your itemized deductions. And your itemized deductions is going to be your healthcare expenditures above 7.5% of your income. It's going to be charitable deductions. It's going to be your mortgage interest and also any investment interest. Anything else that's going to be on there?
Your SALT,
state and local taxes. Yep, that's going to be on there too. So a lot of changes here. What are some of the biggest takeaways for you? And I think you maybe mentioned SALT. That is the biggest change, which probably our entrepreneurs are going to feel a whole lot, but maybe walk through some of your biggest takeaways on these Schedule A or these deductions.
Yeah. So one of the big ones that I don't know, I guess it depends on the entrepreneur how big this is, but they are changing the charitable deduction. This is actually not benefiting the high-level taxpayers. Yeah. So every taxpayer, there's going to be a 0.5% adjusted gross income threshold. So everything up to 0.5% of your AGI, you get no benefit from giving to charity, right? And so to put some numbers to that, if you had $1 million of adjusted gross income, that means $5,000, your first $5,000 of charitable gifts do not help you. By the way, this starts in 2026. Mm-hmm. That's why giving this year is going to have more benefit to virtually every taxpayer than giving in 2026. And remember, you have to itemize for this. But in 2026, it's the 0.5% threshold, but also the most deduction you're going to get. Remember, the highest tax bracket is 37%. Starting in 2026, if you're making more than a little over $626,000 if you're single or $751,000 if you're married filing jointly, you go into the 37% bracket. When you're in those brackets, you do not get a deduction more than 35%.
Yeah.
So it's limits in both ways. And one thing, a planning opportunity is think about doing a donor advised fund where you can get the deduction this year and then give the money out over a period of time in the future. Yep. So then that's before you have the 0.5% AGI floor. It's also before you have the 35% limit on your deduction. So that's one of the big ones. I don't know if you have thoughts on that.
I totally agree. If you're tithing, if charitable giving is ingrained into something that's very important to you, that's how you're going to get around this 0.5% AGI floor for the new charitable deductions. You're going to use a donor advised fund. You're going to do what's called clumping and lumping. You're going to want to put 2, 3, 4 years of charitable contributions in 1 year, and then you can disperse the money to your church or tithe or whatever you want to do over those next 3 or 4 years. But that's how you're going to get around it. So we're going to see a big intake or big uptake in our donor advised funds there. The other thing that I think was interesting was the state and local tax, the temporary relief there. And so really what this goes back to is when Trump redid the tax code in 2017, he capped the amount of state and local taxes, so think property taxes and income taxes, that you can write off on your personal return at $10,000. And the idea being here is it says, hey, well, should the federal government be subsidizing the taxes you're paying at your state level? And so they essentially capped at $10,000. Well, what's happened is that there were more seats picked up by Republican at the House in blue states like New York or California. So those are high state income tax states, but they were Republicans. And since the Republicans had such a narrow margin in the House, these Republican essentially House members in Democratic states had leverage. And so they said, hey, we need to bump that cap up because constituents in my state are paying a bunch in these taxes, and I want them to be able to write it off on their personal tax return. So how did they kind of work this out?
Yeah, well, they created a $40,000 cap instead of a $10,000 cap, but there's a phase out. So the phase out is between $500,000 and $600,000 of adjusted gross income. And when you're in that $500,000 to $600,000, and this is true whether you're a single or married filing jointly, there's a tiny bit, but really for virtually all taxpayers in that $500,000 to $600,000, as you're phasing out, every dollar you make between $500,000 and $600,000 is like you're getting taxed on $1.30 for every dollar.
Mm-hmm.
So what that means is from $500,000 of adjusted gross income to $600,000, your SALT deduction goes from $40,000 to $10,000. In that space, your federal, not your state, your federal tax bracket is 45.5%.
Ouch.
So that's why it's so important if you're right around that $600,000 to find ways to reduce your adjusted gross income to $500,000, because that'll save you a ton in taxes. That's a huge benefit right there. So let's just stop and talk about that, because there's another part of it that I wanted to mention too.
Yeah. Well, what other part do you want to talk about it?
Well, just that sometimes entrepreneurs say, well, you know what, why do I care about, I'm in the $10,000, why do I care about this cap? Because I don't have any state income taxes. So let's say you live in Florida, Nevada, Texas, one of the zero income tax states. Mm-hmm. And I say, well, do you own any property? Oh, yeah, I do. Well, what about property taxes? That falls into the SALT as well. So think about that phase out. But the other thing that they left in, this is what I wanted to mention, is the PTET, the pass-through entity tax. And that allows you to pay your state income tax directly from your entity, if you're a flow-through entity, and not have it show up on your 1040. So in essence, you get to deduct 100% of your income taxes for your flow-through entity.
Yep. If you are a S corporation or a partnership and you are not paying your state income taxes through your business, you're doing something wrong.
Yeah.
That's the bottom line right there.
That could be costing you hundreds of thousands of dollars.
Yeah, especially in California.
Yeah.
All right, well, let's talk through the excess business loss. So this was made permanent. This was Section 461. And really the idea here, and this came out again from Tax Cuts and Jobs Act, and it was really a cap on how much business losses you could use to offset W-2 income, investment income, anything like that, capping it at $626,000 if you're married, $313,000 if you're single. And then if you had more business losses than that, they would all get converted to net operating losses, and then you would carry those net operating losses forward, and net operating losses would only be able to offset 80% of future year's income. So that section was made permanent. Any immediate reactions to 461?
Well, this is one of those gotchas where if you don't understand this, you could really get hurt. And one example is for qualified real estate professionals.
Yeah.
So if a qualified real estate professional, let's say, sells a stock for a bunch of money, and they're thinking, well, I'm just going to offset this gain with losses from my real estate business, and then they're going to find out there's this loss limitation rule, and that they're going to end up paying a bunch of taxes on a lot of that gain. If they knew that this was in place, then they could time it better and push things to different years to try to work within this. Because if you work with this within the rule and you get a 80% NOL, then you can use that in future years for a lot of different things. So that's kind of the takeaway, is understanding how this works and when it could apply to you.
Yep. Business losses are great, but if you have too much business losses, you used to be able to write off everything, but now there's caps on how much you can offset outside of the business income.
Yeah.
All right, let's talk through behind closed doors, a new segment here. Let's talk through the ESOP revolution, and then we'll go into our transaction. So just to set the stage here, there's been a big ESOP boom. We have seen that with a lot of our clients looking to do a lot of ESOPs. And I think the big reason why is really there's a few. There's the silver tsunami, as they like to say, which is a lot of baby boomer business owners that need a liquidity event. I don't think we've necessarily seen that with our clients, just given our clients are a little bit younger than that. But really the cultural preservation, and as private equity has kind of gotten a bad rap, buying a lot of lower middle market business owners or businesses that we've seen in like kind of that $30 to $100 million range. Word's spreading, and a lot of these operators are looking for maybe different liquidity and different events. And so the other thing is that banks are becoming more and more willing to lend as part of these transactions without personal guarantees, and at maybe 2 to 4 times EBITDA, meaning that if you had let's say a $10 million EBITDA business and it was worth $50 million, the business or the bank may be willing to give you $20 to $25 million debt you get that no personal guarantees and you can walk away, even if you did 100% sale.
Yeah, so debt against the business, and they pay out, the entrepreneur gets paid out.
The entrepreneur gets it up front. Yeah, because that's been one of the historical downsides of an ESOP is there's no cash creation. You sell it, and it's kind of trading my stock for an IOU.
Yep.
You pay lower capital gain taxes, 20% instead of ordinary income at 37%. So there's a tax spread there, but there's not a whole pot of money. Whereas you sell to private equity, they're backing the Brinks truck up, and you're getting flooded with some cash. So by getting some bank debt, it makes it a little bit better. Not all of your money is going to be coming on day one, but at least you get some chips off the table, which I think has helped. So why do you think there's been kind of a more demand here for ESOPs?
I think you hit on part of it, which is that private equity is getting a bad rap for coming in and taking an entrepreneur's life, their life's work, and destroying it,
Yep.
or doing things that hurt their employees or things that really upset the entrepreneur, even if they make the company more profitable. A lot of times they do that in a way that would really not be what the entrepreneur would do. So I think the reason, as I think about ESOPs, if we think about why someone would do an ESOP, and then we should talk about why someone wouldn't do an ESOP, but why would someone do an ESOP? It's a lot of the reasons why we did an ESOP, and that is, if you don't want private equity to come in and take over your company and destroy it, or do things that you don't feel comfortable with. Giving up control is big for entrepreneurs. I can attest to that, where all of a sudden you're just an employee of the company. You don't have any say in how it gets run, because private equity usually wants control. So if you're an entrepreneur who wants to continue to run your company, you want to have control, you want to get money off the table, but you believe in your company, so you're willing to be along for the ride longer. You want to support and reward your employees for all that they do.
Right.
It's a great way to do that. So I'd say those are some of the big ones. There's a big tax benefit. Once a company becomes an ESOP, it's a tax-free entity in perpetuity. And what's interesting is it's one of the few complex parts of the tax code that both sides of the aisle, they support it for different reasons. So I think that's some of the reasons why an entrepreneur would be interested in an ESOP. I mean, what would you add to that?
I think you're spot on. I think that why you wouldn't want to do an ESOP is you don't get that liquidity up front. I think that's the biggest downside, is that if you can just get that cash, you can de-risk yourself and future generations. And then the other piece, I think, is that you don't get that growth capital. And so we see a lot of operators and entrepreneurs who want to build their own platform. They want to tuck a lot of different businesses in. They want to use private equity and the resources that they can bring to the table to buy more and more businesses underneath them. Well, if you're doing an ESOP, you're so highly leveraged, it's going to take you several years to pay off your debt. So it's hard to grow through inorganic acquisitions.
Yeah,
so I think those are the biggest reasons. But the big trade-off really there is you're making a deal, and you just really hope that when you're going through that honeymoon phase, that the deal doesn't turn upside down after you lose control.
Yeah, there's one other reason why you might not want to do an ESOP, and that is because when you do an ESOP, you get paid based on an arm's length valuation, right? So you have to have an independent third-party valuation of your company. And by the way, that's good or bad, because I see a lot of entrepreneurs that get beat up on price by private equity, where they end up getting paid less than what an independent third-party valuation firm would say their company is worth. So it can actually work in your favor. But my point is, if your company, there's a strategic buyer who wants to pay because you're so valuable to what they're trying to do from a strategic perspective. They want to pay you so much more than what you're actually worth. And obviously, money speaks. And if that's your biggest concern, then I would tell that entrepreneur, sell for that huge multiple, take your money, and move on.
I totally agree. Yeah, if you can get a strategic multiple, an ESOP would be very hard to justify.
Yep.
And we talked a little bit about the tax benefits. So you referred to the tax-free entity. So if you do a 100% S-Corp ESOP transaction, you're now a completely tax-free entity, which is what we did, and we'll jump into our transaction. Now, you could also choose to do a C-Corp transaction. If you do that, you can actually defer capital gains as the business owner through something called Section 1042 by reinvesting that into something that's called qualified replacement property, which is really kind of domestic stocks, bonds, and real estate. So again, it's a deferral mechanism, kind of like a 1031 with real estate. So if you ever do want to cash that in and get some liquidity, you got to pay the taxes then. There's some workarounds to that, but I think about 70 to 75% of the clients that we see do ESOPs end up going the S-Corp route. Simpler, cleaner, no tax drag. And at the end of the day, they kind of want some of the cash. The deferral isn't super attractive to them because they want the cash, right? They want to recapitalize their personal balance sheet.
Although the deferral, if you die, then your family, your kids are going to get a stepped up basis on that, right? Yep.
Exactly. Yep. So, but I think in reality, at the transactions we're seeing, there's an estate tax issue. So you're realistically moving that out of the taxable estate through different trust planning.
Yeah, that's smart.
So
Yeah.
you're probably
Besides,
not
I
getting a
don't
stepped-up
like
basis.
dying is a good tax strategy.
So, well, it depends. If you're the kids, then when mom and dad die, it's sometimes good.
Right.
Sometimes I
See,
think
luckily I don't have kids.
I think that's probably a lot of people's financial plan is, well, when the mom and dad die, because that's when my financial plan comes true.
Yeah.
That's sad, but that's
Oh, it
probably
is
true.
sad. No, I've seen it, unfortunately.
All right, so ESOPs do have 40% lower turnover. There's one stat that I pulled up here. But let's talk through our transaction. So we did a transaction in 2022. I remember I was in Flagstaff, and I remember the financials came in the middle of the year, and I said, Jim, Mimi, I think we can do this. And we ended up doing a transaction. We sold for $31.38 million. September 1st, 2022. So I know you talked a little bit about why we did an ESOP, and maybe talk through kind of the strategic rationale and then how you feel about doing the transaction.
The first thing I would say is, from a public school math teacher, I would have had to work for 1,500 years to create that kind of wealth. So it was a great moment from that perspective. And I just wanted to publicly thank you, because had you not come to us and said, hey, I'm looking at the financials, I think the ESOP time is now.
Yeah.
We wouldn't have thought of it. And I can talk about the moment when we actually did it, because I remember we were in Park City, Utah, and Mimi and I were out on the deck and just like, wow, we're an ESOP. It was really cool. And then we went out to dinner and drank some champagne. So as far as the ESOP, the rationale or the thought process through this, was that your question? I want to make sure I answer your question.
That was my question.
Yeah. Some of the things I already mentioned, but Mimi and I started to realize, hey, we're getting older and we would like to get some money off the table. And we started getting a lot of interest from private equity. And as we had these private equity conversations, and we have the lucky benefit of, with our company, shepherding a lot of entrepreneurs through their exit. So we've seen the good, bad, and the ugly. And one of the things that we hear over and over is this private equity firm came in and destroyed my business. I built this thing over 20 or 30 years and they ruined it. So from that perspective, we said, gosh, I don't know if we want to do that. And I don't have a lot of hobbies, as you know. I'm a terrible golfer. I love what we do. I love this business. I love helping develop young people within the company. I love our entrepreneurs. So I'm like, what am I going to do if we sell to private equity? So it was all those things in my mind. What am I going to do with my life? What's this private equity firm going to do with what we created over all these years? And what about these people who have worked with us, who are helping us build this incredible thing? And I feel like, we have a long way to go as far as growing this company. I mean, we've had a lot of growth, but I think we have a long way to grow with our model. So based on that, we said, okay, well, what structure or strategy would allow us to still be involved in the business, still control what kind of model we're running, get our employees stock, and then get money off the table over time. And Mimi and I didn't need a lump sum of cash up front, because we believe in this company. We've saved for a lot of years, so it's not like we need the money to live our lives. So all those things checked all those boxes with the ESOP. And then, of course, it was down the path that we worked, obviously together on, is what kind of ESOP? Are we going to do a C Corp, an S Corp? Are we going to do 100% ESOP? And then that's where we landed. S Corp, 100% ESOP. And I have to say, I feel incredible about the decision. I think it's been a lot more complicated than even I would have anticipated. But it's also been the right move for us. It's not the right move for every entrepreneur. It was the right move for us. It was kind of like, there was a movie years ago, and I'm trying to think who was in it, where this very arrogant doctor gets cancer and he becomes a patient. And the whole movie was about him being a patient, right? It was a whole different world. And for me, after all the years of working with entrepreneurs on exits and everything else, to actually be the entrepreneur going through the exit, it was a weird feeling. It was like, I can understand the fears and the concerns and wanting to understand all the complexity and how's this going to work out. And initially, my only regret was in the early year or two, I felt like our employees weren't that excited.
Yeah.
I was like, gosh, this is this incredible thing that we've done to help these employees. They don't seem that excited. But as we'll talk about in a second, as the stock price has grown, as our people have gotten more educated, I'm seeing a lot more excitement, and that makes me happy.
Yeah, I can't agree more. We've got dozens of employees and team members that have 5-figure balances after only a few years, and it's, I think, 6 and hopefully 7-figure balances are on the horizon here quickly. And as you mentioned, when we did the ESOP, since we sold 100%, our share price was 1 penny because the value of the debt that we all took as an IOU from the business equaled the amount that we sold it for. So it was 1 penny. And then with our valuation at the end of 2024, just over $137. So a 13,700% appreciation. Not bad. Yeah, there's some insider trading there, right? But pretty good appreciation and growth. And as you said, as our employees have seen that stock price appreciate, as they've been allocated shares, they see their account balances ballooning rapidly. That's where we're starting to see, okay, yeah, this thing's actually real. It's not just numbers on an Excel sheet and a line chart. This is going up and to the right, and they can.
And we went from what, 1 cent to $25 to $79 to $137. I think that was our path over the last several years. Really exciting. Really the team gets credit for that. Like everyone on the team is pulling in the same direction. So I find that incredibly exciting. One thing that we didn't do, as you know, is we decided not to take bank debt, to get a bunch of money in our pockets. And, it's interesting. That would be a smart move for diversification because you don't want to be too concentrated in business. On the other hand, I don't like banks and covenants and dealing with banks. And I have a very high confidence in our team and in our company. So we all decided together not to take any bank financing. But a lot of entrepreneurs do, and I can see why they would.
Yeah. But I think with us, part of the logic there was that the bank debt was going to carry a lot higher interest rate than what we are getting paid from the ESOP. And that's because we negotiated for more upside equity in exchange for a lower interest rate.
That's right.
And that's really a bet on the future of the business. So we'd rather have a little bit more on some of the upside and then in exchange have a lower interest expense. And the ESOP trustee thought that was a very fair transaction. Yeah. And it's proven, right, that the ESOP trustee is very happy seeing their the employee shares grow from a penny to 137. So last thing about the ESOPs, we talked about the tax benefits. Not too shabby, though. Paying an effective tax rate around 25%. I know I feel good about that. I'm sure you feel good, a lot better than being in the high 30s, low 40s.
Yeah. No, I feel really good about our tax rate right now. And, of course, the ESOP pays no taxes. Yep. But on our personal side, the tax rate it's nice. I enjoy it.
Yeah. All right, well, let's transition to market intelligence. So multifamily crisis or creating massive opportunities. So I was inspired and really just seeing a lot of stuff going on with our clients who have invested in a lot of very well-known real estate syndicators in the apartment multifamily space. One of our mutual friend, Ken McElroy, he did a really cool video with McCompanies, and he, as he said, a crisis is brewing, and I've seen multiple investments gonna get completely wiped out. And these are supposed to be safe investments, and really deep diving on this piece. The first chart I wanted to pull up here is really the maturity of debt, and that's what's coming due. And really what this is showing here is that there's $957 billion of commercial mortgages maturing in 2025. Multifamily is about 23% of that. And so what this is showing is that what happened is that during COVID and coming out of COVID, a lot of people were buying these multifamily, these apartment complexes, and interest rates were super low. And they did it on bridge financing, interest only for 2, 3, 4 years. Never in their wildest dreams did they think that interest rates were going to absolutely skyrocket. Well, what's happening now is that if you did interest only and you just did a bridge loan, now that's coming due and you got to refinance. Well, there's two problems here. There's the interest rate shock that 40% of these maturing loans are at less than 5% interest rate. And right now you're not getting less than 6.5%, kind of probably 7%. 15% are under 4%. So that's crazy, right? That all of these guys now, when they're having to refinancing way higher interest rate expense. The other thing is there's something called DSCR, debt service coverage ratio. This is how banks underwrite the policies. They want to ensure you have enough free cash flow to service your debt. So they look at your free cash flow as a metric of your total debt coverage ratio there. And so originally it was 1.37x, meaning you had $1.37 of income for every dollar of debt. That's now down to 1.07. So there's barely any breathing room here, and most banks want 1.2 to 1.25x dollar or DSCR, which is $120 to $125 for every dollar of debt you're paying. So these two things are converging together. This is creating an issue that I've seen that a lot of these multifamily apartments are getting given back to the bank because they can't afford them anymore. They can't float the debt.
I think this is a great example of why diversification is so important. Yeah. And in the entrepreneur space, these got really hot because multifamily had this long run where they were making all this discretion. And what they were doing, a lot of these multifamily groups, and I know Ken is a lot smarter than a lot of these groups, is they were taking interest-only debt. They were doing a cash-out refi after a few years. All the investors got their money back. They just let the rest roll on, and then they would sell in a few years and make a bunch of money. And everything was working perfectly. So I think the lesson from this, as we're going to get more into this, but I think that the big lesson is diversification. Don't put all your real estate in one type of real estate. Don't put all your money in one type of investment. Diversification is the only free lunch when it comes to things like this. The other thing is stress testing your investments way before there's a problem. It wouldn't have taken a lot of smarts to say, what if interest rates go up a lot? How does this deal look in that scenario, right? And you want to make sure that you can survive through the hard times.
Yeah.
And that's why I think Ken is talking about opportunities that are coming, maybe not quite yet, but that are coming. And I think that's what you need to be aware of. And that also allows you, if you're a smart investor, if you don't over leverage or you don't get over invested in one area, then you can take advantage when something gets overvalued or there's changes in the marketplace that cause that to drop in value, where you can sweep in and get good deals.
Yeah. And before we talk about the opportunity, let's kind of break down. There's 4 variables here that Ken broke down that I thought were great. The first being that floating rate exposure that you talked about. The debt was floating rate. So property owners were reducing their operating expenses. They deferred the maintenance, and now there's some issues with these assets, and that's because of the floating rate debt. They can't afford it. Now they can't keep up their properties. So things are just really deteriorating. The other thing we talked about was DSCR, or debt service coverage ratio deterioration. As Ken said, a lot of the borrowers aren't meeting that debt service coverage test or the debt yield test, so the banks won't even refinance them. So you got to go raise more money. But a lot of people don't want to put money into this asset class right now because they're losing their ass. And then rate cap expiration. We're gonna talk through rate caps and cap rates. And then what he's turning me in this, which I like this, is extend and pretend. Because banks have known there's been an issue here really starting in 2023 when interest rates started really going through the roof. Cap rates expanded, which means the value of these properties is going down while the debt on the interest expense is going up. Those are two things that you don't want to happen at the same time. So banks have been closing their eyes and they've been extending and pretending, just kind of kicking the can down the road a little bit. But that's where, with all this debt now rolling off, can the banks continue to extend and pretend, or are we going to continue to see an uptick in these properties going back to the banks? And I've seen in the last 3 months, I've seen 3 deals go completely belly up, complete wipeout of all equity from the limited partners.
Yeah, I mean, that's that's what's happening. And we're going to see more of that. I think we're going to see more of that before this market stabilizes. And there's been a lot of hope, I think, for some of these variable rate loans that interest rates are going to come down. Yeah. And I think we can all agree that interest rates have not come down as fast as most people had expected. And anytime you invest in something and you're hoping the government's going to change rates in a dramatic way, that's probably not a good place to be.
Yep. Totally agree. All right. Well, next chart, we've got a historical chart here that goes through and actually breaks down the historical cap rate. And cap rate, for those viewers who are not super familiar, is your net operating income in the numerator, which really is the income or the profit that your company or that the real estate makes before any debt. And then the denominator is going to be really the value, your in-place value of it. So it's a fraction there. And it was 4.5%, which meant that the average property was essentially yielding 4.5% if it was unlevered. That ballooned up to 5.75%. And so since it's you can do some algebra here, and the exit cap rate, you want a lower exit cap rate because that means as you push your NOI up, you divide it by a smaller number that gets you a larger exit multiple there. So cap rates going up from 4.5 to 5.75% means that if that property, if that multifamily property did not do anything to improve their net operating income, so net operating income just stayed where it was, you lost 22% in value by just hanging out where you were. And that's because there's a lot less money flowing into this asset class, and so that's pushed cap rates up. And there's a lot more competition because when interest rates were zero, getting 4.5%, 5.5%, unlevered yield wasn't too bad. But now I can go park it in a money market fund, and the Fed's probably going to cut here soon, but I can get 4% risk free. So why would I want to go, get 4.5% or 5% and invest in a multifamily project when I can get 4% risk free? So cap rates were ballooned up, and this has again created some pressures here on the back end for these developers and these flippers.
Yeah, and your point also about raising money, because these deals, the solution for the syndicator is raise money.
Yeah, plug the hole.
Money would solve the problem.
Yeah, plug the hole.
The problem is people don't want to give more money. And the worst thing to get as an investor is a capital call not a planned capital call. That's a different thing. If it's a planned capital call, like, okay, we only need this much now as we're building this project. We'll need more in a year. We'll let you know.
Yep.
But it's like, we're in trouble. We need your money. And then as the investor, you got to say, do I want to throw good money after bad? Or is there a chance that this will actually survive? And if I don't put more money in, then I get, watered down in my value. And that's a tough place to be. But for these syndicators, they're really having trouble raising money to try to plug the hole.
Yep. Don't put good money after bad money.
Yep.
All right. Well, we talked about interest rates going up, the cost of debt going up, cap rates going up, which means the value of these properties is going down. Well, the other big variable is net operating income, or NOI. Really, again, kind of like the income from these properties, ignoring any of the cost of debt. Well, NOI was projected to go up and to the right. When you were coming out of COVID, remember, rents were going through the roof. I remember I had one of my rental properties, I think the rent increased by 30%. Now, they locked in for 2 years, so they got me good. But then 30% rent increase when I got new tenants in there, which was just, it's crazy to think about. And at that time, though, these operators in this space thought rents were going to continue to go up to the right forever. So they were modeling 5% year-over-year rent growth forever. But what happened was the exact opposite. So operating expenses started to balloon. You've got operating expenses up 28% in the last 12 months, according to Globe Street. Insurance costs have really gone up in really hot markets like Florida with all of these hurricanes. Insurance costs are through the roof. Texas, insurance costs are going really, really crazy, up 129%, $636 per square foot since 2018. So your expenses will go up. Well, what makes that worse? What about rent growth decelerating? So next chart I got here from CoStar shows the actual year-over-year rent growth. This is pretty recent here as of July 2025. And you can see San Francisco is actually coming back. San Francisco and Chicago, those markets got hammered during COVID. So they're coming back. The AI boom's really helping San Francisco. But if you look at the right-hand side of the chart, Austin, Denver, Phoenix, Tucson, Dallas, Fort Worth, Raleigh, Charlotte, these were some of the hottest markets, the Sun Belt, where everyone was building all these multifamily properties. And now look at negative year-over-year rent growth. So you're not getting the 2, 3, 4, 5% rent growth. You're getting negative rent growth. So not only are interest rates going up, not only are cap rates going up, but also your NOI is going down. Literally nothing is going in the right direction for these guys.
Yeah, and that's where I think there's going to be some opportunities, Now, the careful thing you have to be is, when there's all kinds of problems with one class of investments, you have to be careful about which ones you step into and at what time, So I think the key is the operator. You want to make sure that these are people who've done this for a long time, have navigated this, and who haven't done the things that a lot of these operators did, really not out of their own fault, just for a lack of looking of what could go wrong and playing a little bit of defense. I saw a lot of multifamily, pedal to the metal, offense, and no one was thinking about defense.
Yeah.
And sometimes when you have a market that goes on that long, you should think a little bit about defense or what might not go well. So I think there'll be opportunities. I don't think we're quite there, but I think they're coming.
It was the can't lose asset class for a few years there, and now it's the can't win asset class is what it feels like.
Yep.
All right, well, next chart here, lending activity by origination. The government agency is ticking down. This is the Fannie and Freddie. That's the holy grail of financing here. But debt funds now represent 17%. So that dark blue line is inching up. And this is to your point of there's some private debt funds now getting into the space. Again, only 17% of these loan originations, but they're plugging the hole, and they're coming charging a lot higher interest rate. And this is, again, because a lot of the banks have really tightened their belt. They don't want to get involved in this asset class. They've been extending and pretending. And so, loan to value ratios are coming down. I just don't see any relief here coming soon.
No, I agree with you.
All right, well, we'll talk through. We'll be interested to see, there's going to be some opportunities here. So it'll be interesting to see. There were a lot of people raising preferred equity and mezzanine debt, trying to plug that tranche of equity that was missing because the values were going down and they were having to refinance. And so they were trying to go back to their LPs, like you said, raise more money and then plug that hole, offering 12, 16%, and being preferred in the capital stack. But even after doing a lot of that, I think they've kind of fired that bullet. I don't think there's any more money because now even I saw one that actually went back to the LPs, capital called, did a new tranche of mezzanine debt at 12%. All of that's gone. All the LPs are gone. They're all wiped out. So I think people are learning their lesson here of, like you said, don't put good money after bad money.
Yeah, agreed.
All right, well, let's wrap this up. That's it for today's podcast. Let's take this thing home. Jim, what is your biggest takeaway for 7 to 9 figure business owners with what we've discussed today?
I'd say my biggest takeaway is what we just talked about with the multifamily, and that is, as simple as it sounds, not getting too excited about one part of your portfolio, not over leveraging and not over investing in one area of your portfolio. I think that's the one takeaway, because I've seen it so many times in 30 years. People get excited, and you want to make sure you're spreading the money around, and that you're also stress testing your portfolio. Like, what if? Yeah. What if interest rates go up a lot? What part of my portfolio is going to get hurt the most? And then just kind of pay attention to that and see how you're going to navigate through that.
Yeah. Well, my biggest takeaway, I dangled a carrot at the very beginning, ESOPs and cannabis companies.
Oh,
and so ESOPs
yeah,
have been really, we haven't had so many conversations around ESOPs than we're having with our client base here now. But cannabis companies are joining in on the fun with the ESOPs. And do you know why? Section 280E only allows cannabis companies to write off their cost of goods sold. They can't write off any operating expenditures. So they pay taxes on gross profit, not net profit. So their effective tax rate's around 60%. So why do they want to do an ESOP? Do an S-Corp ESOP. You become 100% tax-free, and now all of that the free cash flow is created for you. So we felt good doing that transaction. Imagine paying taxes on your gross profit, not your net profit. So that's why they're paying, really, like I said, they're paying like 2 to 3 times more in taxes because it's still not legal, and that's Section 280E. So cannabis companies are super big in ESOPs too. So I kept that carrot back because I just wanted to give you a little bit of a knowledge nugget there.
That was good. I didn't know that. You just educated me, and makes me realize why we went to build fractional family offices and not into selling marijuana.
Yeah, that's a tough business.
Yeah.
I wouldn't know.
If I would have known that, I don't know. Maybe we would have been doing different things.
Maybe. You'll never know.
Thanks for listening to Make Rich Real, where $1 million businesses meet billionaire strategies. Please note the following disclosure.
This podcast is provided by Do Wealth Management, an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or training. The information presented in this podcast is for educational and informational purposes only and should not be construed as personalized investment advice, tax advice, or legal advice, or a recommendation to buy or sell any security. Nothing discussed in this podcast constitutes a solicitation or offer to provide investment advisory services to any person in any jurisdiction where such solicitation or offer would be unlawful under the securities law of such jurisdiction. All information presented is believed to be reliable, but is not guaranteed for accuracy or completeness. All investing involves risk, including the potential loss of principal. Past performance, if mentioned, is not indicative of future results, and no investment strategy can guarantee profit or loss. Any mention of specific securities, investment strategies, or market performance is for illustrative purposes only and should not be considered a recommendation. Economic and market conditions are subject to change, and any opinions expressed are currently only as of the date of this recording. Before making any investment decisions, please consult with a qualified financial professional who can assess your individual circumstances, risk tolerance, and investment objectives. For more information about our services and fees, please refer to our ADV Part 2A, which is available at our website, dowealth.com, or upon request.